Let's go to David Madden, market analyst at Equiti in London. Welcome back to the program, David. Now, can we just go back down to the basics? What do higher interest rates mean for households and businesses?
Well, it's going to translate into higher borrowing costs in households, credit card debt, credit card repayments, car loans, mortgages. These are all likely bills that are likely to increase in the kind of weeks and months ahead. Obviously, some people will have fixed rate mortgages, but typically the term period for fixed rate mortgages isn't usually very long in most cases. So broadly speaking, households are going to be hit in that regard. And when it comes to businesses, similar situation, overdraft charges, any kind of outstanding loans, or even long-term debt obligations, they're likely to be hit by higher costs too. And not only will have a direct impact in terms of higher repayments because the underlying borrowing cost has gone up, it'll also have an indirect cost as well, because people will now actually be rethinking certain plans that they previously had. Perhaps individuals might be thinking about, might be reconsidering taking up that new car loan they were eyeing up, or perhaps certain companies might be thinking to themselves, oh, we were going to open up a second factory, we were going to open up an operation in another jurisdiction. Now the borrowing costs are increasing and look as if they're going to keep increasing in the quarters ahead. Perhaps we should look to rethink that. So there's not only an actual cost, there's also an opportunity cost at play as well.
Right. So what you just laid out there means slower economic growth. So that raises the risk of a recession in major economies, doesn't it? Can you explain that for us?
It certainly does. And this is quite a difficult time for central bankers. It's also a very challenging time for businesses and consumers, because the post-pandemic boom is over. We've seen some reports from the eurozone indicating that the services sector, the manufacturing sector, is either in slowing growth or even in negative growth. Costs are rising. There's concerns about energy security in the eurozone, and to top it all off, interest rates are going up. Therefore, borrowing costs are going up. And as I mentioned a moment ago, it's quite clear that the European Central Bank have further interest rate hikes planned in the pipeline. So with that, things are looking to be getting worse and worse. So it's a very challenging time, because growth is slowing, costs are rising, and it looks as if borrowing costs are going to keep on rising as well, all of which point to an increased likelihood of a recession.
All right. David Madden at Equiti Capital in London. Thank you for joining the program.